You think the 2008 crisis hurt the rich? Think again. While you lost your job, your savings, your home, billionaires were buying assets at fire sale prices. Every crash is the same. The poor get crushed, the rich get richer. And it's not luck, it's the design. Financial crises don't destroy wealth, they transfer it. From the many to the few, from the unprepared to the positioned, from those who panic to those who pounce. And if you look at history, really look, you'll see the same brutal pattern repeating across every major collapse. The 1929 crash, the 2008 meltdown, the 2020 pandemic shock. Different decades, different headlines, same outcome. The rich walk out richer, and everyone else is left wondering what just happened. Let's start with the most recent example because it's still fresh in memory, even if the lessons have already been forgotten. In 2008, the global financial system came within hours of total collapse. Lehman Brothers fell. Bear Stearns vanished. AIG needed an emergency bailout. Trillions of dollars in market value evaporated. Unemployment soared. Foreclosures swept through neighborhoods like wildfire. Families lost homes they'd spent decades paying for. Retirement accounts were gutted. The middle class took a beating that many still haven't recovered from. But while ordinary people were losing everything, something else was happening quietly in boardrooms and trading floors. The wealthiest individuals and institutions were preparing to feast. How? Because they had something most people didn't. Liquidity, cash, reserves, the ability to wait out the storm and then buy when everyone else was forced to sell. Think about what happens in a financial crisis. Asset prices collapse. Stocks, real estate, businesses, they all plummet as panic spreads. For someone living paycheck to paycheck, this is disaster. They have no cushion, no reserves, and when the layoffs come, they're forced to sell whatever they can just to survive. Their home goes into foreclosure. Their retirement fund is liquidated at a loss. They're selling at the bottom because they have no choice. But for someone with deep pockets, this is opportunity. When housing prices dropped by 30, 40, 50% during the 2008 crash, institutional investors and wealthy individuals swept in and bought properties by the thousands. Private equity firms like Blackstone became the largest landlords in America almost overnight, snapping up foreclosed homes at rock-bottom prices. They didn't need mortgages, they paid cash, and now, more than a decade later, those same properties are worth double or triple what they paid. That's not luck, that's leverage. And it's the same story in the stock market. In March 2009, the S&P 500 hit its lowest point since the crisis began. Ordinary investors had already sold in panic, locking in their losses. But the wealthy, they were buying. Warren Buffett famously invested $5 billion in Goldman Sachs during the height of the panic, securing a sweetheart deal that guaranteed him massive returns. Billionaires poured money into beaten-down stocks, knowing that eventually the government would step in, the Fed would print money, and asset prices would recover. And that's exactly what happened. By 2010, the stock market had rebounded. By 2013, it had fully recovered. By 2020, it had more than tripled from its 2009 low. Anyone who bought at the bottom made fortunes. But the average person? They sold at the bottom and never got back in. They were too scared, too broke, or too busy trying to survive. The result? The wealth gap exploded. Between 2009 and 2012, the top 1% captured 95% of all income gains. The crisis didn't hurt them, it enriched them. And here's the part that should make you angry. This wasn't an accident. The system is designed this way. When a crisis hits, governments and central banks don't save people, they save institutions. In 2008, the Federal Reserve and the US Treasury bailed out the banks. They injected trillions into the financial system to keep it from collapsing. And who runs the banks? Who owns the stocks? The wealthy. So when the government rescued the economy, what they really did was protect the assets of the rich while leaving ordinary people to fend for themselves. The same playbook was used in 2020 during the pandemic. When COVID-19 shut down the global economy, markets crashed. Unemployment spiked. Small businesses closed by the hundreds of thousands. But once again, the Federal Reserve stepped in with unprecedented money printing. Quantitative easing on steroids. Trillions of dollars flooded the financial system. And where did that money go? Into stocks, real estate, and assets owned by the wealthy. The S&P 500 recovered in record time and then soared to all-time highs, even while millions were still unemployed. Billionaire wealth increased by over $1 trillion during the pandemic. Jeff Bezos, Elon Musk, and others saw their fortunes skyrocket, while ordinary people struggled to pay rent. This isn't new. The pattern goes back further than most people realize. Let's rewind to 1929 and the Great Depression, the grandfather of all financial crises. When the stock market crashed in October 1929, it wiped out millions of Americans. Banks failed. Savings disappeared. Unemployment reached 25%. People stood in bread lines. It was economic devastation on a scale the modern world had never seen. But even then, some people got richer. How? The same way: liquidity and patience. While everyone else was liquidating assets in desperation, the ultra-wealthy were buying. Joseph Kennedy, father of President John F. Kennedy, famously exited the stock market before the crash, and then used his cash reserves to buy real estate and businesses at bargain prices during the Depression. By the time the economy recovered, he had multiplied his wealth many times over. The Rockefellers, the Mellons, the Morgans, these families didn't just survive the Depression, they consolidated power. They bought up failing companies, foreclosed properties, and distressed assets. The crisis didn't break them, it made them dynasties. And this is where the system reveals its true nature. Financial crises are not random acts of God. They are the result of over-leveraged systems, speculative bubbles, and reckless lending, problems created by the very institutions that profit when the bubble pops. The rich don't just survive crises. They engineer the conditions that create them, then profit from the collapse. Consider how bubbles form: easy credit, low interest rates, speculation. The financial system encourages people to borrow and spend beyond their means. Housing prices skyrocket. Stock valuations inflate. Everyone feels wealthy on paper, but it's a mirage. The moment confidence cracks, the bubble bursts, and those holding debt are destroyed. But those holding cash and assets? They win. This is where the Cantillon Effect comes into play. A concept most people have never heard of, but that explains so much about how money and power really work. Richard Cantillon, an 18th century economist, observed that when new money enters the economy, it doesn't affect everyone equally. Those closest to the source of money creation, governments, banks, financial institutions, benefit first. They get to spend the new money before prices rise. By the time the money trickles down to workers and savers, inflation has already eroded its value. The early recipients get richer. The late recipients get poorer. And that's exactly what happens in every crisis response. When central banks print trillions to stimulate the economy, that money flows first into financial markets and large institutions. Stock prices rise, real estate prices rise. The wealthy who own these assets see their net worth balloon. But for the average worker, wages don't keep up with the inflation that follows. Their paycheck buys less, their savings lose value. They feel like they're falling behind because they are. The system is built to transfer wealth upward every time the money printer turns on. Now let's talk about information. Another reason the rich win in crises is because they have better information. Not insider trading, though that happens too, but access to networks, advisors, and data that ordinary people don't have. When a crisis is brewing, the wealthy are often the first to know. They have private wealth managers, hedge fund strategists, and connections to power. They adjust their portfolios before the crash. They move into cash, gold, or safer assets. By the time the news hits the mainstream and panic sets in, they're already positioned. Ordinary people, on the other hand, are always the last to know and the last to act. They rely on financial news that lags reality. They take advice from sources that don't have their best interest at heart. And when the crisis hits, they react emotionally, selling at the worst possible time because they're scared. The rich don't operate on emotion, they operate on strategy. And that asymmetry, information, timing, resources, ensures they come out ahead every single time. Then there's the role of debt. Debt is sold as a tool for prosperity. Get a mortgage, buy a house, build wealth. Take out a loan, start a business, chase the dream. And for some, it works. But for most, debt becomes a trap. When a crisis hits, debt doesn't disappear. It becomes a chain. You still owe the bank, but now your income is gone, your assets are worth less, and you're forced to liquidate at a loss just to stay afloat. Meanwhile, the wealthy use debt differently. They leverage it when times are good, but they're never overextended. They have cash reserves, diversified holdings, and the ability to weather storms. Debt for them is a tool. For everyone else, it's a noose. And here's the cruelest irony. The same institutions that lend recklessly during boom times, inflating bubbles and encouraging people to take on dangerous levels of debt, are the ones that get bailed out when the system collapses. The borrowers, regular people, are left to default, foreclose, and declare bankruptcy. But the banks? They're too big to fail. Governments step in to rescue them with taxpayer money. So the public pays twice, once when they lose their savings and homes, and again when their tax dollars bail out the institutions that caused the crisis. This is why the wealth gap explodes after every crash. It's not a flaw in the system, it's a feature. Crises concentrate wealth because they create conditions where only those with resources can capitalize. The rest are too busy surviving. And as the cycle repeats, bubble, crash, bailout, recovery, the distance between the top and everyone else grows wider. So what's the lesson here? First, understand that financial crises are not equal opportunity disasters. They're selective. They punish the unprepared and reward the positioned. Second, recognize that the system is not designed to protect you. It's designed to protect capital. When a crisis comes, governments and central banks will move heaven and earth to save the financial system, but that doesn't mean they'll save you. Third, liquidity is power. Cash, reserves, and the ability to act when others are panicking. That's what separates survivors from victims in a collapse. And finally, the most important lesson. History doesn't lie. The pattern is clear. Every major financial crisis transfers wealth upward. The 1929 crash enriched the Rockefellers and Kennedys. The 2008 crisis enriched hedge funds and private equity. The 2020 pandemic enriched tech billionaires and asset holders. The names change, but the mechanism stays the same. Crises don't destroy wealth. They redistribute it. And unless you understand how the game is played, you'll always be on the losing side. The question isn't whether another crisis will come. It will. The question is, when it does, will you be ready? Will you have liquidity? Will you understand the patterns? Will you resist the panic and see the opportunity? Or will you, like millions before you, be forced to sell at the bottom and watch as the wealthy buy up everything you lost? History doesn't repeat, but if you don't understand it, it will crush you all the same. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.